So the folks who actually have some backing to the education they're teaching, I've interviewed. In fact, one of these days I've been threatening. I've been doing this for over 15 years, taking all these interviews and throwing them into a book or something. Um, but I've been looking for, like, what do they all do the same? And over the years, I've come up with these four things in this priority order. So to answer your question about what I would focus on or what I would prioritize learning, number one above everything else is risk management. I would figure out how to, on any one of your positions, how to make sure that you limit the risk. And so our knee-jerk reactions are use stop loss orders and or protective options, right? And what are the pros and cons of those two risk management things? So managing trade risk, but also the other part is position sizing. So with option trading, you have to remember that everything is done in lots of 100. So back to that Amazon thing, Cyprian made a good point, or even Goldman Sachs. Let's go back to Goldman Sachs. Cip made a point when we were looking at Goldman Sachs that, hey, it's kind of pricey. Think about it. In order to do just the minimum option trade on this, you need to have 100 shares of this stock. So the initial purchase of this, minimum initial purchase, is going to be $34,278 based on the price it's going at right now. So that's the initial purchase of going long the stock. You can buy a a substitute option at a cheaper price, but remember, those substitute options have leverage. So what I challenge you to do is actually determine, in whatever trading strategy you're using, with whatever instrument you're using, determine how much is the maximum you can lose. So where would you set your stop loss order? Where would you buy your protective put? If you bought a protective put, don't forget to add the price of that protective put into your math and determine exactly how much in the worst case scenario you could lose. And then go ahead and determine how much you want to expose your portfolio to. So for instance, if I determine that if I buy some of that Goldman Sachs at whatever, and I get stopped out in the worst case scenario, I'm going to lose 20% of the trade, and I only want to be able to lose 2% of my portfolio in any one trade. That means my position sizing should only be 10% of my portfolio. If I only invest 10% of my portfolio into Goldman Sachs, and Goldman Sachs goes down and I get stopped out at a 20% loss, my portfolio will only suffer a 2% loss. I hope that math kind of works out for you. And so with that said, that means that my minimum purchase of $34,248, that's the going price. I see that bouncing around in my chart here. That can only be 10% of my portfolio, which means in order to trade this with options, I should have a portfolio over $350,000. If I follow basic risk management rules, there's no way I can be in a situation where I lose like more than 2% of my portfolio. And every successful trader knows how to do these calculations in their head. So that's number one thing I would focus on. And any newbie trader who has gotten themselves into a lot of hot water, I find that this number one priority that successful traders do, that either they've done it wrong or they didn't even think of doing risk management. Number two, this is just for option trading, but understanding option selection, right? How picking the expiration dates and picking the strike prices, how that changes how the options behave. Because option selection, it's not just picking a call or a put, although option type actually does have an influence on it, but it's also expiration dates and strike prices. You need to understand how option pricing works. Do I go deep in the money? Do I go at the money? Should I go far out in time? Should I go near term? Should I go 3 to 6 months? All of that makes a difference. And then I guess the last two things, one of them would be, equity or underlying symbol. Let me put underlying symbol because a lot of times we can do option trading against indexes and ETFs, not just equities. Underlying symbol selection. And finally, um, timing of entries and exits. We've been talking a lot about that. We looked at the trade from Milo and no, not Milo, from Roy and from Lydia about timing, and they had already figured out the timing. And they were asking me, I guess, about the option selection and the risk management. So, timing, it's interesting when you go to one of these trade shows, you go out on the exhibit floor where all the exhibitors are there talking about their different tools. They all focus on timing and or maybe some filters on underlying symbol selection, which is actually the last on the list of prioritization around knowing what's best to trade. If you don't have risk management and, in the case of option traders, option selection down, you're going to go nowhere fast except maybe lose your money very quickly. And in that case, if you're going to go into trading without risk management under your belt, why don't you just I'll give you my personal address. Why don't you write checks to me, because I'll use the money better than you just giving it away to the market. Trying to
Yeah,
be
you can
funny
write me a
there.
check. You can write me a check too. I'll take a check.
Because
uh,
I'm telling you, there's so many people, Sip, who do not do risk management. So, Milo, risk management, get it down. Just make it ingrained in you. Don't over leverage yourself, especially with options. Don't get yourself, make sure you can evaluate max risk. Make sure you can calculate position size. It's very simple, but nobody, very few newbie traders think to do it.